Every dollar in your wallet has lost about 96% of its value over the last 100 years. That's not a typo. And here's the part that should make you angry. That loss isn't an accident. It's policy. In the next 8 minutes, I'm going to show you 3 things your government would prefer you didn't think too hard about, where money actually comes from, why inflation is a tax nobody voted on, and who really wins every time prices go up. None of this is fringe. All of it is on the public record. And by the end, you'll start seeing the system the way the people running it do. Let's start with the question almost nobody asks. Where does money come from? Most people picture printing presses and government mints. That's mostly wrong. When a bank gives you a mortgage for $400,000, it doesn't move $400,000 from another customer's account into yours. It types the number into existence. The loan creates the deposit. That money didn't exist 5 seconds before you signed. In a fractional reserve system, banks are legally allowed to lend out a multiple of what they actually hold. The Bank of England came right out and admitted this publicly in 2014, and most economic textbooks still get it wrong. The Federal Reserve's own data suggests more than 90% of all dollars in existence today were created this way, not printed, just typed. Every car loan, every credit card balance, every business line of credit summons new money the moment it's signed. So when politicians say, "We have to be careful about printing money," they're describing a problem their banking partners cause every single day. The government doesn't need a printing press. The banking system is the printing press. Now here's where it gets interesting. When new money enters the system without new goods, prices rise. That's inflation. But what almost nobody tells you is that inflation is functionally a tax. Imagine you have $100 in your savings account. The government runs a deficit. The central bank buys the bonds. Money supply expands by 8%. Your $100 now buys what 92 used to. You just paid $8 in tax. Nobody asked you. Nobody voted on it. The line item never appeared on your pay stub. Income tax requires a vote in Congress. Inflation tax requires a meeting at the Federal Reserve. Guess which one politicians prefer? It's the perfect tax, invisible, blamed on greedy corporations or supply chain issues, and impossible to escape unless you know how the trick works. Pull up any chart of the U.S. dollar's purchasing power since 1913, the year the Federal Reserve was created. The line goes one direction, down, through wars, recessions, booms, relentlessly down. That's not failure. That's the design. This next part is the most important thing in this video, so listen carefully. There's a 300-year-old idea called the Cantillon Effect, named after an 18th century economist, and once you see it, you can't unsee it. When new money is created, it doesn't fall on everyone evenly like rain. It enters the economy at specific points, banks, governments, large asset holders, and ripples outward. The people who get the new money first spend it before prices have adjusted. The people who get it last receive it after everything has gotten more expensive. Who's first in line? Wall Street, defense contractors, real estate developers, anyone who can borrow at near-zero rates. Who's last? Wage earners, pensioners, people who held savings instead of leveraged assets. This is why asset prices keep hitting record highs, while groceries somehow cost 40% more than they did 5 years ago. Look at what happened between 2020 and 2022. The U.S. money supply grew by roughly 40% in 2 years. Stock indexes hit records. Real estate became unrecognizable. Meanwhile, real wages adjusted for inflation, actually fell. The new money wasn't shared, it was caught. It's not a paradox. It's the system working exactly as designed for the people closest to the money spigot. Here's something your bank will never tell you. The single worst place to store money long-term is in a savings account. If your bank pays you 0.5% and inflation runs at 3%, you're not earning interest. You're paying the bank for the privilege of letting them lend your money out at 7%. Over 30 years, $100,000 sitting still loses roughly half its real purchasing power. That's not saving. That's a slow leak. There's a finance rule of thumb called the Rule of 72. Divide 72 by your real rate of return, and that tells you how many years it takes your money to double. At a negative 2.5% real return, your money never doubles, it halves. Roughly every 28 years, it halves again. The wealthy figured this out generations ago. That's why old money sits in land, equities, businesses, and increasingly hard assets, not in cash. The financial advice the average person gets, pay off your mortgage early, max out savings, stay safe, is advice that benefits the bank, not you. There's a reason the rules they teach in school don't match the rules the rich actually play by. And here's the part of the story that's still being written. Every fiat money system in recorded history has eventually broken. Every single one. The Roman denarius, the French assignat, the German Papiermark, the Zimbabwean dollar, the Venezuelan bolivar. All started solid. All ended worthless. The pattern doesn't change, only the names do. When governments run out of ways to inflate quietly, they reach for harder tools, capital controls, withdrawal limits, and now central bank digital currencies. A digital currency from a central bank isn't just digital money. It's programmable money, money with rules attached. Spend it by Friday or it expires. Can't be used on certain categories. Frozen if you say the wrong thing online. This isn't a conspiracy theory anymore. China rolled it out. The European Central Bank is testing one. The Federal Reserve has white papers published on it. The question isn't whether this is coming. It's whether you'll have positioned yourself before it arrives. None of this is meant to scare you. It's meant to wake you up. Once you understand the rules, you can play the game. If this opened your eyes, watch the next one. I break down exactly where to put money when the printing press never stops.